Hey everyone, James Cordes here with the Mora Group. It is May 14th, 2025. Thanks for checking in with this mid-month market update. Let's jump into it. Number of releases this week when it comes to economic data and activity. We got really good news with the CPI yesterday, the Consumer Price Index, showing inflation dropping more than expected to 2.3%. Tomorrow, Thursday, the PPI, the Producer Price Index, is going to be coming out along with retail sales. Those are going to be really important when it comes to how the bond market is doing, how mortgage rates are going to do, and really what inflation is showing us. Despite those numbers being positive or negative, a lot of people are arguing that everything going on with tariffs and what the economy is going to do with the tariffs are really going to drive the markets. But obviously getting good information on lower inflation is what we're looking for and hoping for. I want to use this market update to share some information on non-QM or portfolio loan products. There's a lot of talk about them out there. If you're a realtor or you're a referral partner, you've probably heard that term, non-QM. You've probably heard portfolio. I want to spend a couple minutes sharing kind of just a 101 on a number of different non-QM products out there, ones that we use all the time. They're extremely valuable, but I also know they can be intimidating because it's not necessarily what you're aware of or what you know. So real quick, 101 on non-QM portfolio loan products. First off, let's start with what non-QM means. Non-QM stands for non-qualified mortgage. That simply means it's not a Fannie Mae, it's not a Freddie Mac loan. It's for that borrower who maybe doesn't fit the box for Fannie and Freddie. They're still financeable, they can still make the mortgage, but maybe there's something in their tax returns, or maybe there's something in their finances that Fannie and Freddie might not like. That's when you look or turn towards non-QM. Now, non-QM and portfolio essentially mean the same thing. Okay, that lender has its own stipulations, has its own underwriting for that, and that's your non-QM portfolio loan. Let's start with bank statement loans. Bank statement loans are killer loan products out there. What it takes is 12 months or 24 months of business bank statements. You can also use personal bank statements. Typically, you're using business bank statements. We take the business ownership, we take an expense factor, and we basically divide that by all the deposits that have come into the business bank statements over the last 12 or 24 months. More times than not, these business bank statements are going to show significant more income than tax returns or pay stubs. In fact, we don't even take tax returns into the file. We don't use them. They can't be in there. We don't look at pay stubs or anything like that. We're just looking at the business bank statements, ownership state, expense factor, and that's how we're underwriting the loan. Number two, asset qualifiers, asset depletions. These are for borrowers who might not have steady income, but they have a large chunk in their asset accounts, whether it's retirement, brokerage, checkings, and savings. We take those asset accounts, we source them over 3 to 6 months, depending on the loan product, and then we divide that, again, depending on the loan product, by 84 months or 120 months. Whatever that comes out to, we give them that income. Okay, so this is for that borrower, again, who maybe they're not working, maybe they're retired, but maybe they have $1 million in assets. Maybe they have $2 million in assets. We're going to divide it by 84 months, and then that's the income that we can use for qualifying. Number three, DSCR loans, debt service coverage ratio loans. Think investment properties. This sounds complicated because the title of it, DSCR, is a little complicated, but really what it comes down to is the rent on the investment property needs to equal 1-to-1 the new mortgage. For example, let's say you want to buy this investment property, you're going to put 30% down. There's no lease on it yet, there's no tenant in it yet, so we have the appraiser do what's called a 1007, a rent market analysis. And that appraiser comes back and they say, this property will rent for $3,000 a month. You're going to put 30% down. You can put as little as 20% down on these loan products. The more you put down, the better chance you have of hitting that 1-to-1 ratio. Let's say you put 30% down. Let's say that new mortgage, all in, principal and interest, property taxes, homeowners insurance, and HOA if there is one. If all of that equals $3,000, remember that's what it's renting for, $3,000. If that equals $3,000 or less, you've hit that 1-to-1 ratio, boom, you qualify just like that. There's no income for this, okay? You just have to have good credit score, and you have to have that money for the down payment. If they hit the 1-to-1 ratio or less, it qualifies just like that. It's a great way to buy an investment property, knowing it's going to cash flow, knowing it's going to cover itself, and it's a quicker way to get into it than having to necessarily qualify with tax return. And number four, non-warrantable condos. When it comes to underwriting and financing a condo, it can sometimes be trickier than a single family residence. And that's because each lender is going to have to underwrite not just that specific condo, but the condo project in general. And if that condo project has any issues with insurance, with HOA, anything like that, it can hold up the financing or perhaps not allow for it to go through. With non-warrantable condo, non-QM or portfolio loans, we can underwrite a condo that might have some sort of flaw in the condo project approval. Maybe there's something going on with insurance on another one of the units. Maybe the HOA has something complex with their insurance. Maybe they have some litigation going on. Whatever it might be, our non-warrantable condo portfolio product allows us to maybe take a step further in financing that condo that might not be financeable with other products or other lenders. There are other non-QM portfolio products out there. These four that I just went over, bank statement loans, asset qualifier loans, DSCRs, and non-warrantable condos are some of the more common ones that we have seen. We use non-QM portfolios all the time. If you have a borrower or client out there who's not sure if they're going to qualify, this might be something for them to look into. If nothing else, you have a little bit of an education on non-QM portfolio loan products. Reach out if you have any questions. Thanks for checking in. We'll talk to you next month.